Let's dig into the numbers a little bit more. Ed Lee, media reporter of the New York Times, and Bernie McTernan, analyst at Rosenblatt Securities, join us. Bernie, I'll come to you first. What's your take on these headline numbers?
Certainly. So it's the 2.5 million guide for 3Q is what matters the most. That's why the stock's selling off, despite the beat on 1Q. What's interesting as well is operating margin guide, 16% for 20. They have a new guide now for 21, which they didn't have before, of 19%. That's roughly in line with consensus. And then also on free cash flow, they expect this year to be break even to slightly positive versus $1 billion burn before. So almost a flip here that normally you have bulls focused on subscriber growth. Well, the good part about this earnings period is actually probably the free cash flow. And the bears normally focus on the lack of free cash flow, probably have something to dig into on the subscribers here.
On the headline that Reed Hastings is getting a co-CEO in Ted Sarandos, Ed Lee, the chief content officer. What's the significance of that?
It's a momentous change for sure. It's also been a long time coming. I mean, interestingly enough, Ted has been the most visible executive. In fact, he's the one that they put out in front of the cameras, or anytime the reporters call in, they always make him available as opposed to Reed. He also gets paid the same amount. But it's also been a part of the shift where Netflix has really moved or shifted from being more of a technology-focused business to an entertainment and media-focused business. And that's really Ted. It's the content that drives the business, that drives the new subs. Not to say that tech isn't important, because that's a huge part of Netflix's offering, what differentiates Netflix from all the other businesses out there, even though the other guys are doing streaming now as well. Netflix still leads on the tech side of things, but it really is a sign of, it's more of a Hollywood-facing business, and that's been Ted's job.
Of course, on the content question, a big one was when we could get back into production to make sure we didn't fall off a cliff of new production. They're saying that they're back into production in countries like Germany, France, Spain, Poland, Italy, and the UK. They recently resumed production in California, but hope to add more U.S. production this quarter in North America. The share price down, 10% or so in after-hours trade. A reminder that, of course, up 63% year-to-date coming in to these numbers. Julia Borson's been digging through the release, has a bit more color for us. Julia.
Yeah, no, Wilf, I just want to point to Reed Hastings' comments about competition. Hastings never shies away from addressing competition, and he notes that all the major entertainment companies like Warner Media, Disney, and NBC Universal are pushing their own streaming services, and two of the most valuable companies in the world, Apple and Amazon, are growing their investment in premium content. He also says TikTok's growth is astounding, showing the fluidity of internet and entertainment. And then he says, instead of worrying about all these competitors, we continue to stick to our strategy of trying to improve our service and content every quarter faster than our peers. Our continued strong growth is a testament to this approach and the size of the entertainment market. And to your point, Wilf, about production, Netflix really has been a leader in terms of maintaining production and restarting production during the shutdown. So he talks about the success there and how the pauses in production are impacting competitors and suppliers similarly. But because they have such a deep library, he says they believe our member satisfaction will remain high, even though they are starting some production there. And then just looking at the impact of COVID, they do believe that user growth will slow down. I think that's why they're forecasting those relatively low numbers for the third quarter, because they do believe everything has been pulled forward earlier in the year.
Bernie McTernan, to come to you next. I mean, Peacock, obviously, on the topic of competition, which Julia was addressing. Peacock, parent company NBC also owns Peacock, is launching as of yesterday. Is that a threat, or have they shown Netflix in the last 12 months that they can kind of fight off all these other new streaming launches?
Yeah, with Peacock, I think they will be a leader in premium digital advertising over time, but because of things like the Olympics getting pushed out, that was really the main content that was supposed to be coming in 2020. So in 2021, you have The Office, you have the Olympics, you have an NFL wildcard playoff game, and then in 22, you have the Olympics again, as well as the Super Bowl. So I think eventually Peacock could be more of a player in the streaming wars and potentially drive more cord cutting as well, as you get high quality sports moving out of the bundle and to streaming. But I don't think it's going to be a 2020 theme. One other thing that I just wanted to mention that we're really focused on for the call tonight is any commentary on price increases. The CFO last time around said that they're not looking, price increases aren't even on their mind, but Really, forward revenue growth here is one of the reasons why we've been neutral rating on the stock, and we're looking at high teens revenue growth a year, forward revenue growth a year from now, and so looking for any commentary there.